All right, welcome back, everybody, to our mid 2025 market update. Wow, it's been a pretty wild ride so far this year in 2025. I mean, we started with not knowing who our new prime minister is going to be, to everybody kind of getting ready for Trump, part two, and so of course all that's kind of played out now. So some of the political unrest, so to speak, has kind of subsided. The dust has settled. We know who we're dealing with going forward. But here we are. And I wanted to start off by just touching base on some of the seven key factors that affect real estate. Um, so some of the key factors, seven of them is kind of what we narrowed it down to, is population growth is always a key factor in real estate. Economic conditions, of course, ownership and affordability, which is tied to our rates, investor activity, very important in the market, replacement cost, housing supply, and consumer confidence. I would say that out of those key factors right now, I mean, there's a lot of headwinds affecting us there. But I'd say the biggest one out of everything is the one I've outlined and put a little star and asterisk next to, which is the consumer confidence. That is a huge, huge problem in our market today. We're going to touch on that a bit, and we have some key metrics that show us that it's a problem for us right now. So let's just continue. I like to always touch on some of the headlines and kind of dig into them as well. Yes, some of our new home sales have crashed, no question at all. 72%, I'd say, is a record low. Structurally sound and sentimentally weak. That talks about the Toronto housing market, and that touches base on what I mentioned earlier, the consumer confidence aspect of it, and we'll dig into that. Um, Canadians permanently left in the second highest volume ever. So we measure emigrants, or emigration, which is they call it, which is the opposite of immigration. And it's reached a peak right now. And you'll notice that a lot of that might be tied to the headline next to it, which it says Ontario unemployment rate surges to recession highs. Now, that doesn't tell the whole story. So the reason our unemployment is starting to surge is not necessarily because we have a problem with employment. It's because we have an oversupply of labor. So we had such a tremendous increase in immigration over the last several years that we just couldn't fill those jobs. And so back to that headline on the left where people are starting to leave permanently. Well, I would say to you that yes, some of them are Canadian citizens that are cashed out and done really well in the real estate market and are, taking their money and moving somewhere abroad. But it's also probably a lot of people who have come here for a better life, looking for a job, and they're not finding it. And so they're leaving, they're packing up and leaving again. So that is a huge problem for us right now, is that we have so many people here and we just don't have enough jobs to fill all the people that have come here for labor and to get a job. This is a really important slide. So our consumer confidence. This is, remember, this is self-induced. So Canadians, we're a little cautious. We see Donald Trump, telling us he wants to take over Canada and annex us, and he wants to cripple us economically, and that rightfully so. That scares a lot of people in the market, and it spooks people, and that is a big driving factor behind this consumer confidence that's plunged. Um, so people are worried about this trade war for sure. Strained household budgets. There's higher interest rates we've had to deal with, and 67% of us feel it's a bad time to make a major purchase right now. And that's also a very key factor because everyone is on the sidelines, just kind of waiting for this fog to clear. And so that's going to have a pretty big impact when people start to come back to the market. As it did with COVID, there was a backlog, and you'll see it happen again. And it's going to be a wild ride when it does come back and everybody jumps back into this market. So tariffs, here we are. This is one of the key driving factors that's affected our consumer confidence. So, we're talking about tariffs that we haven't seen in over 100 years. It's just a huge, huge factor that's weighing on everybody's decisions these days. Okay. Bank of Canada, they've done a pretty decent job of bringing rates back down. We are expected to maybe see another two for this year, which will get us to neutral. Neutral is supposed to be around that 2.25% rate. So we're waiting on that and see how that goes. But right now, they've been in a bit of a pause for the last couple of announcements. Unemployment and mortgage defaults are rising. Now, this is a bit of a problem. um, Unemployment and mortgage rates are rising. That is a big thing that can affect the real estate market for sure. Okay, now we're still with defaults, we're still at a very near record low, but it's starting to concern some economists because it's ticking up. And the same with unemployment, which we touched on earlier, but there's an underlying factor there. Too much labor in the market right now. Here's something that a lot of people in Toronto may not be aware of. Okay, so we are far less exposed than many other cities across North America for US tariffs. Okay, and mostly we're focused on Canada here, but Toronto, you can see it only represents about 8.4% of our economy, whereas opposed to places like Sudbury, where it's like 82%, or, we've circled some of the ones that closer to home that are affected more, like Hamilton, Guelph, Brantford. So, this is not something that's going to affect Toronto as much, yet it still has an impact. And that's where the consumer confidence problem is. Now, here is something that's interesting. If you go back as far as you can and look at our MLS sales um, going way back to 1996, where they were at a record low. Well, we're actually not as low as we were back then, but because we've added 2.5 million people in terms of population in the city during that timeline, that brings us to a per capita record low by far. So definitely there is a lot more sales to be had. We're not seeing those sales at this point in the market, but we will, because people just don't stop buying forever. This is a blip in the market. We're going through a difficult time as far as consumer confidence goes, and again, a lot of this is self-induced. Um, you'll see our new listings are near a decade average. Active listings reach record high, but um, you've never seen them quite this high. Like, it's just a huge spike in listings right now, and that of course is bringing us up to, if you look at how many listings actually sell out of all the listings that we have, active listings, it might be somewhere in the level of 25%. So 1 in 4 are actually selling. So huge amount of listings right now, not a lot of sales. So the sales to listing ratio is super low right now. Here is an interesting note. Our price point is still holding extremely well. So if you look at the chart on the right where I've got the red box around it, you'll notice that after that kind of spike that we had in February 2022, where we hit the peak, it's basically the market's been going sideways and it's kind of holding in line with 2021 numbers. So we're not seeing a huge drop in our resale homes. This is good, and this is important because it shows the resilience of our market. Okay, so this is something to watch. I don't think, after everything we've gone through, I don't think we're going to see any huge drops in the market. Yes, you'll see some small ebbs and flows, but certainly nothing that's going to crash the market. It's been really holding up well with all the headwinds we've gone through and continue to go through. New condo sales, well, that's definitely not the same story. New condo sales have crashed, and you can't even imagine. If you look at this chart here, no one could have ever predicted condo sales being this low. But again, this all has to do with consumer confidence, but this is also a buying opportunity. So I think right now, 73% of our sales in the market is first-time home buyers. Imagine if you're a first-time home buyer, how fantastic it is for you to see your condo sales this low, which is it's a drag on the price. And so that's very helpful for people who are first-time home buyers. So opportunities there for a segment of the market, certainly. Um, Now let's talk a little bit about what's happening with condos. So the development charges. I mean, when you increase your development charges 171% in the last 8 years, I mean, it just doesn't make it feasible. Why would I, as a developer, want to start a new development? In addition to that, they have to deal with unsold units, with the sales being so low. So it's a bit of a perfect storm that's happening right now in the condo market. And you can see here, I know I've shown this chart before, but development charges or development profits only account for 9 to 12% of the overall cost. Okay, of when you put together all the government charges underneath that, and you'll see it's almost double. It's just so much. It doesn't leave enough of a profit for these developers to jump into these enormous projects. And so you'll see that over time now, all the completions that are set to come in the coming years are dropping off rapidly. And once you get to 2028 and 2029, there's going to be near zero completions. That is going to really help the condo resale values going forward, because there's not going to be any new completions. So I would argue that anyone who's buying today is going to be looking at a tremendous return in the next 4 or 5 years, because the market's going to dry up with these completions, right? You can see um, on the top left, I have a little chart that talks about negative cash flow. So people who are making purchases right now, or taking closing on these pre-construction condos that they ordered years ago, they're just not getting back the amount of money for their investment. They're in a negative cash flow situation to an average of $1,182 per month. That's $1,182 per month. That's the average. So there's definitely there's a spread there between the cost of ownership and what they can collect in terms of rent for their investment, to recoup their investment, and they're in a negative cash flow. So it's a little difficult for investors today, but rates are probably still going to come down a couple of more times this year, which will be very helpful. And you know, everything that goes up goes back. Everything that goes down goes back up. And same thing when things go up too fast, we get a little bit of a pullback. So right now, I would argue the pendulum's going to start swinging back the other way, but not quite this quickly. It's probably going to take another good year and a half, maybe 2 years, to clear up some of this backlog before we start to see the pendulum swing back. So it's definitely a great time to buy in the resale and pre-construction condo market. There's a lot of good opportunities there. So some of my key takeaways: watch out for potentially another 2 further rate cuts for this year. It'll help offset the softening economy that's largely due to these tariff impacts. There's tremendous buyer's opportunity in the condo market, resale and pre-con. Employment is softening is a concern. We have to keep an eye on that. Yes, a lot of it is due to just so much labor available in the market, but it's still a concern. Resale housing market holding very steady and strong on pricing, which we touched on. So that's the good news story there. And good opportunities overall. It's a buyer's market. So if you're looking to buy, this is the time you want to be looking. I hope that was helpful. Feel free to reach out directly if you have any questions about your specific micro market. I'm always there to help. Okay, thanks for listening.